let's talk a little bit about, again, lessons we can learn from 2022 as we wrap this year up. Um, you were talking about how people got sloppy, and this market was not forgiving. I mean, it was not like, the late 90s where, look, if you bought extended, oh, who cares, it's just going to go up more. um you know the same thing happened in 2020. So talk a little bit about the importance, I guess, of discipline and keeping those rules even when things are good, and especially when they're bad.
Okay, so this year, the lesson that almost everyone forgot is that stocks in bear markets can go down so much farther than anyone expects. I mean, look at this, Affirm and Peloton and Zoom and all these names. People are, there's going to be tax loss selling coming into this end of the year. And also, I'd like to briefly talk about the year end, the next couple of weeks. But look, before that, the lesson is prices can fall so much farther than people think. But let's talk about getting it right. The anatomy of a true market leader is between 5 and 7 beat and raise quarters, which is earnings acceleration. If you get into a stock that is going to, after you buy it, have 5 to 7 beat and raise quarters, I'll show you what's possible with that. This is out of the paper from 15 years ago or more, maybe. But I'll just give you a couple really quick. CMGI, up 8,729% in 105 weeks. Yahoo, up 7,449% in 130 weeks. Amazon, up 3,800%, 70 weeks. SDLI, 3665% in 66 weeks. RF Micro Devices, 3,424%, 72 weeks. And there's a list of about 12 or 15 of these. I found it last night in I have massive files of all the valuable stuff in the paper. It totally corroborates my 98-week true market leader run cycle. Mm-hmm. If you're not sitting, and that's another thing, why do so many people fail in the market? I discussed it. They take all these losers, and then they sell their monster winner. If you're not going to sit through 4, 5, 6, 7 beat and raise quarters, you're missing all the monsters. If you sell before every earnings release in a bull market, you can't get the monster gap ups. The anatomy of a true market leader is an earnings surprise, which changes everyone's valuation and estimates, and the stock's got to adapt and move. And there's the cockroach theory. You're in college, you're looking at these crappy apartments, and you see one cockroach come out from under the counter. There's 20 more under that counter. One blowout earnings surprise, they're rarely one. I mean, if you have all the other variables, pre-tax, after-tax, ROE, all over 20%, and everything in the right sector, you're going to very, very likely going to have a string of these things. And so I'll just tell you, the other names that I didn't mention were QLogic, Emulex, Qualcomm, VeriSign, Celera Genomics, JDS Uniphase, and Applied Microcircuits. The weakest of those was up 2,005% in 72 weeks. That was Applied Microcircuits. Wow. You know what? How many of these names are even around anymore? They're dead. They're gone. There's a few, but several of them are gone. The names that we saw lead, the FANG names, Apple, Tesla, all this, with Amazon, they can not only can they, statistically, historical statistics will tell you they're not coming back, or if they do, it'll be 10 or 15 years. And I did another study, the statistical probability of a TML in the next cycle becoming another TML, not in the next cycle, but at any time in a lifetime, is 2.4%. So if you're buying past cycles leader, you have a 98% chance of being wrong. Mm-hmm. And so, these are all Bill's rules. These are basic things. But what are people doing? They're talking about, I was on this call the other day, and everybody wants to talk about Datadog and Tesla. Tesla has relative strength of 11.
So, Jim, actually, let's talk a little bit more about Tesla, right? Because Tesla's the poster child for the COVID bull market, right? I mean, probably the biggest beneficiary. And it hung around there for a while. It was hanging in there. It's probably hanging in there better than most of the large cap tech stocks. But now it's starting to crack. And, there comes a point where you just have to say, look, something's wrong with the stock. I'm losing money. I need to lighten up or get out of the stock.
I agree with a lot of what you said, but you said it's starting to crack, and that's not true. This thing rolled over.
Right.
It started living below the 200-day. Look at the price when it was.
Right.
I can't see your charts; they're so tiny on my screen. But what's the price of it right there?
Right here?
Yeah.
Right there, it was at 290.
Okay, and it's
now it's
160?
at 156, right? Yeah, it's 1.
Okay, so if you
it's
just said
61% off its high right now.
Yeah, I mean, this is a Paul Tudor Jones rule. Below the 200 is a no-go zone. I call the 50-day moving average the guardrail.
Yeah.
If it's below the 50, now I'm not talking about a glancing blow. That's a subtlety, and it might go below it, above and below for 3, 4, 5%. But a Friday close below the 50 by more than 5%, especially if there's heavy volume involved, I'm usually out.
Yeah.
If you would
now, Jim, just to clarify, I didn't want to state the obvious that it has been struggling for a while because I didn't want to upset too many of our listeners.
Upset them. They got to learn. That's what bear markets do. They teach people.
Trying to coddle them a little bit.
Would Bill coddle anybody?
No, Bill would not.
No. Well, then why would you teach anything but what Bill said? Shame on you.
Take him out to the woodshed.
See, Bill was nice to me because I was a paying customer, but he'd call and I'd go, "Oh, I'm in X," and I could just hear him go. I mean, he wouldn't tear me up like some legendary stories that I've heard, but I could tell he was displeased with me. So anyway, people got to learn. You're just going to lose money if you're not adhering to these basic tenets and principles. It's in the book, but it's counterintuitive to psychology. People want to do it their way. Nobody rambling.
No. I mean, that's because it has been struggling for a long time. It has been pretty obvious. It gave tons of sell signals. I mean, it is a classic case study to go back and see how many sell signals it's given over the last 6-7 months. So yeah, you're right where you have to learn this, and I think everyone. That's part of the learning process, especially if you're newer to this. You're going to get caught in a bear market. You're going to give back a ton. Now the decision is, and everyone's kind of looking at the abyss at that one point. Are you going to learn from it, or are you going to put your head in the sand, right? And just say, "Oh, it's a market."
Most people will not learn, and they'll go. There was a stock that came public like in the early '90s, and it was called Wonderware. And it kind of rolled over after the IPO. And I'm like, this thing's done. It's toast. And my customer goes, but it's Wonderware. I'm like, Wonderware, Schmunderware. It's below the 50, bro. I mean, but it's Tesla. But it's Enron. Enron was on the cover of like Fortune, I think, right before the top. It's WorldCom.
Right.
You can't sell that. Those things are gonzo. The rules, living below the 50, that's a get out signal.
Yeah.
If you're an intermediate term trend trader. Now, if you're a really long term trend trader, I think the 200 it's far too long to wait if you wait that long.
Or there's like the death cross. Some people wait for the 10-week line to cross below the 40-week line, and it's like, how much do you have to give up for that to happen?
Once a stock is, I used to say 20% off the high. It's getting into the too much zone. Now I think it's around, in my opinion, around 23% off the high or meaningfully below the 50-day. Those two things are, if you just followed those right there, you would catch the bulk. It's astounding how many companies with triple-digit sales and earnings will not break the 50 until it's over.
So the Tesla right now is 39% below the 200-day.
Yeah, that's pretty deep. Okay, so let's talk a little bit about. Okay, that's on the defense side, and I absolutely agree with you. The 50-day is such a good guardrail. You can give it a little bit of room there, but you don't want to do too much room below there. It's such a great early warning signal. And by the way, Jim, I also do have to just comment real quick that your exasperated sigh sounded so much like Bill to me. So you're following in his footsteps in more ways than just the lessons. The exasperated sigh sounded very, very familiar to me.
That is an honor that should not be bestowed upon me. I'm
But
striving to be half as good as Bill. That'll
well,
be
you got the
just fine.
exasperated sigh down. So let's talk about on the plus side. Okay, so we've got a lot of stocks that have been looking interesting. Whether it's the end phases of the world and things like that. But we've got this market that has not been cooperating. So how aggressive do you get? Let's talk position size. You never know when that market's going to turn, but you're seeing some of these that look decent. So what do you do position size to start, or do you just say, look, I'm going to wait until it's really obvious and the market has really shown it's truly turned instead of this slopping back and forth?
This is such a big, critically important topic. If you wait until it's completely obvious, you're probably about to have the general market go into a tiny digestion, which will shake you out of everything, and you're probably buying extended. And this is a critical Bill issue that I would talk about with Bill that he didn't really talk too much about in public, but when to step on the accelerator, like when to really ramp it up. In this market, the amount of stocks that are being faded, end phase, I mean, just you go down the list. I mean, the volatility, the failing breakouts, or the soft, weak breakouts with no follow through is a major signal. So how much? If Bill would trade 100 lots, Bill O'Neill would test with 100 lots all the time.
Yeah.
And he's running greatly more money. Probably some of the fund managers that are listening to this, Bill had more money in his personal account than they have in their fund. And if he's trading 100 lots, trade 100 lots until you get real traction. And, like, how about this? It is, if you look at the new highs, every new bull market witnesses an explosion in them. It's impossible to have a big turn in a market without raging new highs. We're nowhere near the 10-week moving average of new highs, new lows. Not only has the new highs not exceeded new lows in the whole bear, the new lows are expanding right now.
Yeah.
You've got to have, when to put the hammer down is when your 100 lots are working, you have corroboration and breadth of leaders, which we have nothing like that. You have to, like I said, you have to buy 10, 15, maybe even 20 breakouts to catch one good one. That's not the environment. And this is time for the brakes, not the accelerator. It's too difficult. It's it's emotionally painful. That burns your capital, your mental capital. So when the real move occurs, you may be paralyzed at that moment. You can't suffer the damage in the bad period and expect to be in good mental condition when the turn comes. And it's going to come. All those names I listed are just from one cycle. We're going to have this technological innovation. And this is just a conversation I have with people. And I'm like, do you think the ramping technological innovation could compensate for the lack of Fed accelerant on the market, and we could still have a pretty significant bull rally in the next phase beyond the uncoiling of the spring? In Growth Stock Mentor, I have this spring that's crushed down, and I put a couple of them in every issue because right now we're compressing that spring and it's going to uncoil. And okay, tangent. How can you beat the market if you don't have earnings accelerating faster than the market?
Mm-hmm.
Earnings acceleration, earnings surprise, earnings beat, and raise is the anatomy of a true market leader. It's a major component of it.
Right. And, before we get too far, I want to just real quick, because Arusha had in the background, he had some charts up showing your point. And I wanted to make sure that for those that are watching this video, which is available at investors.com/podcast, that they're kind of just aware of this. So 2 places you can go to. If you're wanting to look at the New York Stock Exchange, you can type in NYEXG, and we can pull that chart up. Arusha's got it ready. So yeah, you can see that the what you're looking at here on the bottom is the 10-day moving average of the new highs, which is the blue line, and the new lows, which is the pink line, which has been dominating the blue line for as you said, the entire year, you can see a couple areas where there was a threat of a crossover, like right around the end of March, in June, and then a little bit in August, and then more recently. But the new highs, just that average hasn't gotten any traction. And for those that are in market
Pull up the NASDAQ.
yeah, if you want to pull up the NASDAQ, that's NASDQ.
Yeah, obviously the NASDAQ's been the weaker of the two indexes this whole year, and so the new highs, new lows. And Jim,
look what it's doing
hope
right
you
now.
can see it.
You can
just
kind of
see it starting to peak up a little bit. The new lows.
Mm-hmm.
All right, I'm going to out my buddy Charles Harris. You ready?
Yeah.
He considers this to be one of the most important features on Wanda. Wanda has a very similar version of this. He's probably going to be pissed off at me that I gave the golden secret away. But this page, and if you look in the overbought, oversold oscillator, when it got down, that was the lowest reading in the history of that since it's been kept on Wanda.
Yeah, in January, right over here, it was the lowest. He went back like 30 plus years or however long, which my mind was blown at that time when
that gives you an idea of the severity of this bear. The indexes are still masking the damage to growth. This has been, in some respects, it's not as bad as the 2000 bubble or the 0809, but it smacks of it. It has that in growth land. We're getting there. And you know what follows those? This.
Yeah. So
one thing just with that overbought, oversold, one thing that a lot of, especially newer traders will make is they'll say, "Oh my gosh, this is the most extreme level ever on this indicator. It must be the bottom of the market, right?" But the problem is oscillators that become oversold when you're in a really bad market, they can stay oversold, and it's actually a negative. It's not necessarily a positive, as we've seen this year.
And sentiment. People are talking. They have been talking bear for a very long time. The investor intelligence sentiment readings have been very, very negative, and we've continued to go down. Now what we're starting to finally see is outflows. Lipper is showing, I think, 3 or 4 of the last 5 weeks outflows. It's my bad. I am unfamiliar with the magnitude of the outflows, and if we're at historic levels of significant outflows, and we can have outflows for a great period of time. Okay. But here's the thing. Until I see the VIX, the put to call, these things are acting like there's no bear market. The put to call, I've seen the put to call at 2.6, 2.8 before. The VIX, we haven't seen crazy high volume index capitulation. And I'll tell you, if anybody subscribes to Lowry's, I got to give them a massive shout out. And it's too technical to go into, but they have these internal buying and selling power indicators. And they're like, this rally's exhausted. And the rally's been on lower and lower power, and the selling pressure's rising. We're at the downtrend line, the 200-day. I know we could break out to the upside, and we really should just follow trend. But where's the leadership? Where's the power? Where's the capitulation? And like you said, we got on this with sentiment and extreme. We could stay extreme into the early part of summer or whatever. Prognostication. At some point next year, we are going to have a massive opportunity. And if you're all in cash, and I stress this, in GSM, I talk about this a lot. If you're all in cash right now, you have very limited risk. Stay in the game, keep focused, and when things start to get traction, get ready to hit that accelerator because it's coming. We're way past. It's my assessment. We are at least, at a minimum, over halfway through. If this is going to turn out to be a historically bad market, we're over halfway already.
Yeah.
And if you're in cash, how much more can you get hurt?
Right. And one of the indicators for us, we're looking at sentiment, and of course, these are all secondary indicators. But one of the really key indicators for us, in addition to the fall through day, is powerful breakouts that are actually getting traction. And you'll see tons of them. All of a sudden you become the kid in the candy store, right? Like, where did all these bases come from? Where did all these breakouts come from? Now I have a bigger problem of which stocks do I buy, because there's so many stocks going.
I call it stock envy.
Yeah.
And when like Arusha, exactly what Arusha said, in the moment, either the week before the follow-through day and then the 3, 4, 5 weeks thereafter, they just come out in mass. And you're like, ooh, I didn't get the research done on this one because I was completely unaware of it. And I want to talk about two that very few people are aware of right now. It's not going to be Apple. It's not going to be Amazon and Tesla and all that stuff. It's going to be new names that are super under-owned because no one knows them yet. There's going to be a whole plethora of new darlings that are going to come out. We haven't seen that. And, when they come out, it's like, I just try to buy as many as possible with as much as I have and then do the research because they're going to come out with such force power. Now, you still have to have all the key variables, okay? As long as you have all those key variables and you don't quite know the fundamental story, I believe I can buy them pretty big, then do the research and then eliminate the ones that I don't believe in the fundamental story and just get down to that exclusive list. And those are the ones that are going to do 4,000%. And you just don't have to get for it. What if you only catch a 200? In my life, I think some of the biggest gainers I've ever had outside of crypto were 300%, and I caught the whole move. What's the value of 20% of your whole account in a stock that goes up 200, 300%? Yeah. You only have to catch one of those a year. It's life-changing.
It's true. Yeah.
Mm-hmm.
So exclusivity. Bill was looking at 5 stocks, and he probably only had big money in 2.
Right. And, to your point earlier, a lot of times, okay, you're maybe doing some buying, maybe you don't have all your research lined up in a row, but there is also that market feedback mechanism of, the market kind of tells you, hey, these are the ones that are working and these are the ones that aren't. So I would see Bill do that all the time where all of a sudden money's shifting from some of the stocks that aren't working and it's shifting to the ones that are. And, he referred to that so many times as, weeding the garden, right? You pull out your weeds, you water your flowers. You don't do it the other way around.
Hey everyone, thanks so much for watching Investors Business Daily on YouTube. If you want to watch more videos, make sure you hit that subscribe button so you don't miss a thing.